Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 39. Charlie Bilello here, and with me, as always, my co-host Peter Mallouk. Before we begin, Peter, just want a quick note to everyone who's watching this. Go to creativeplanning.com/Charlie before year end. Get a free wealth path analysis. With that, we're going to give you a second look on your portfolio, your financial plan, making sure everything's in order. Creative Planning, we're in all 50 states. 325 billion plus in assets under management and advisement. We're here to help. So reach out today, creativeplanning.com/Charlie. Okay. What's on the docket today? Just two things, Peter, but a lot to cover here. 7 lessons from 2024. Interesting year thus far. We're going to run through everything that's gone on and what you should take away from it as an investor. And number two, here we go. 36 trillion in debt. We've hit that another milestone. I believe this is the fifth one since you and I have been started this podcast, Peter. So we'll decipher this again. Is this signal or noise for investors? What it means for everybody going forward. All right, 7 key lessons from 2024. Number one, returns are lumpy. I know you love this chart here, Peter. The year hasn't ended yet, but 2024 for now is in that 20 to 30% column. S&P total return with a month left in the year up 28% year to date. What's your takeaway from looking at this chart for investors?
We always talk about the average market return, around 10%, which is kind of what we see here. Of course, depending on how far back in time you go, you can look at it could be 8%, it could be 12%. Let's call it about 10. It just almost never gets that number, right? And we use in retirement projections a number smaller than that to be conservative. But the reality is dispersion is very, very dramatic. And most of the time, but not always, to the upside. And so what should be expected by an investor is to have really great returns sometimes and to have horrible returns about 1 in 4 years, actually a negative return about 1 in 4 years. And when you think about the average, it's like having a foot in hot water, a foot in cold water, and saying the average temperature's just perfect. The volatility is why investors get rewarded. This chart illustrates that, I think, better than any other.
Okay, so here's a few interesting stats for you here, Peter. Looking at this chart here of returns, I highlighted the years in which the S&P 500 did a return of 25% or more. You could see on the upside, and on the downside, you could see the number of years where it was down 25% or more. Now, what's your guess in terms of what percentage of years actually did the S&P 500 finish up 25% or more? Just take a stab at that.
I'm going to guess if it's positive 3 out of 4 years, I'm going to guess 20% of the time.
Pretty good. Actually, a little bit better, 27% of years. So more than 1 in 4 years. This stat really surprised me as well. More than 1 in 4 years, you're seeing a return above 25%. So that 10% long-term average, very lumpy. As you can see on the downside, not as many, right? So only 5 times, so about 5% of the time have we seen returns down 25% or more the last time in 2008. And here's one more stat for you, Peter. This is back-to-back. If we hold these gains today, back-to-back gains for the S&P 500 above 20%. Last time that happened, 1998, 1999. I highlighted here all the times where we had back-to-back gains of 20% or more. So pretty good back-to-back years after that 2022 when people were saying, some people were saying, sell everything, get out of the market. We're going to have a recession. Inflation is going to be turned into hyperinflation. Now we have back-to-back years potentially above 20%. What do you make of this?
Unpredictable. Play the long game. Play the long game. Play the long game. I mean, you're never going to make sense of it. Also, I think one interesting part of this is 2022. The market was down 18%. And everyone always tends to look at periods like that and go, oh, it's going to take me 3 years to get back to even. And historically, that's just generally not how it works. Market tends to be like a rubber band. You pull back on it, it tends to spring forward eventually, right? And make up a lot. Once the clouds dissipate, it tends to make up all those losses in very short order.
Yep, absolutely. Once you hit that low in the bear market we've talked about, it's not a steady move higher. It tends to be a very sharp move higher. We saw that in 2009 after 2008. You had a big return. 2003 after 2002. And we saw it again in 2023 and thus far this year. Let's go to number 2 here. Price targets are pointless. We feature this all the time, and I'm picking on strategists. I'm technically a strategist, but I don't play this game. But look at this chart right here, Peter. We're over 600 points higher than the highest prediction coming into the year for the S&P 500 and 24% now above the average analyst target coming into the year. So safe to say all those gains that we just talked about, really no one was anticipating an outlier year like this.
I mean, predictions are worthless, and this is just proof of it. I mean, if people making their livings telling people where the market's going to end for the year and how to reposition their portfolios on an annual basis, I mean, I don't know how much more proof people need, yet people still follow prognosticators that say, hey, this is what's going to happen in the coming 12 months, and you should reposition for these reasons. These are some of the top people, the top firms in the world, 100% of them wrong. Some of them bet the market would be down. I mean, it's just absolutely worthless to get a prediction over the short run.
100%. I think I went on CNBC one time and they asked me this, and I just simply said, "I don't. How would I know where it's going to end exactly?" They did. Safe to say, they did not like that answer. You're supposed to know with certainty. And J.P.
Mhm.
Morgan, biggest bank in the world, they have a team of analysts, enormous, right? Researchers, everything else. They had 4,200 as their price target. Obviously, did not pan out. And you can see here in their market outlook from last December, they were talking about 2 to 3% earnings growth. And they essentially were saying, Peter, we're going to see a slowdown. And unless the Fed does this massive easing early on in the year, we're going to have a terrible year for equities. And then you have the situation where you get to the middle of the year and you either have to stick with that call or you have to do an about face. And most of the time, they do a rapid about face. That did not happen here. You could see from June here, they stuck to that price target, which signaled at the time 23% downside risk for the market. And lo and behold, here, Peter, I just checked it yesterday. What happened? Well, the head guy is now gone from JP Morgan, and whoever took his place is now bullish and sees the S&P 500 rising 8% next year to 6,500.
One of my favorite things about a lot of analysts is they just take wherever things are today and they add 8% to it, and they call that their 1 year target. But I mean, come on, I mean, like a lot of people follow J.P. Morgan and their predictions, and to say the market's going to go down 23% year to date, the market's up about that amount. I mean, you're just 100% wrong directionally and percentage wise. I mean, stop with the predictions. Just stop with the short-term predictions. The stock market's very predictable over very long periods of time, extremely unpredictable under short periods of time, over short periods of time. This is another year. I mean, not that we need another year, but another year of why that is so. And on top of this, let's say that they were just perfect about their reasoning, right? Let's say they're perfect about their reasoning. Stuff happens, COVID, 9/11, things like that, that are unpredictable, right? So even if you believed, like the guy at JP Morgan sits down, he has all this information in the world, and he's going to be precisely accurate about everything. Yeah, if there's a terrorist event, obviously, we can all agree that would change things, right? And so we accept that that's the norm, that's the reality. And so don't ever make decisions about your portfolio that are based on 1, even 2 or 3 years. It just doesn't make sense.
Yeah, the worst thing possible is that they end up getting it right. They get a few calls right, and then people are saying, well, this guy actually is able to predict the future, and you follow that. And obviously the worst thing to follow is missing out on gains when someone's predicting downside, because then you're acting by selling out of your portfolio. Now what do you do with this new information? If you're a client of JP Morgan, now do you jump back in at this point after missing out on a 28% gain? It's a very difficult game to play. It's why we don't play it. And this is why it's so hard, Peter, to predict. So JP Morgan predicted 2 to 3% earnings growth this year. It was actually 10%. So they were way under on that. But what's much more difficult is to actually predict investor sentiment, changes in sentiment. And what I'm showing you right here is changes in the S&P 500's P ratio year to year. And what actually goes on is most of the time there's either a big multiple expansion or a contraction. So even if you're able to predict earnings, which tend to go up around 6% per year historically, Well, your odds of predicting this part very, very low. So this year, there's been a 15% multiple expansion on top of that 10% earnings growth, and that's how you got to the big gains from this year. But next year, nobody knows which direction this is going to go, which makes it almost impossible to predict it. You could get lucky, but the last few years they have not gotten lucky. If you remember, 2023 was the first year they were predicting a down year for stocks. We got an up year, of course, up over 20%. So this is a few years in a row where they've not only gotten it wrong, but gotten horribly wrong. In 2022, nobody predicted a down year. And of course, the S&P 500 was down 18%. We could keep going with this, but we'll end it right there. Predictions are pointless, and price targets are a ridiculous game to play. Don't play it. All right, lesson number 3, embrace panic. There wasn't too much panic this year, Peter, but you and I actually recorded an episode on the day of the most panic that we had seen in quite some time. And if you remember, the funny thing is, if you look back, it's kind of a distant memory. No one's talking about it. No one mentions it. But that particular day, there was some real fear. There was some real panic. The Nikkei was crashing over 2 days. It was down 17.5%. And that was the biggest 2-day decline for the Nikkei in its history, bigger than October 1987. And it spilled over into the U.S. markets. And you and I recorded it that morning when the VIX was spiking. Remember, it went over 60 at one point, and then it ended up closing at 38, had one of its biggest 3-day spikes in history. And what we talked about at the time is you need to embrace this type of panic if you have any long horizon as an investor, because what tends to happen following periods of panic?
Yeah, I mean, whenever whatever it is causes the panic is resolved, you see a recovery. But it's not just that you see a recovery; you tend to receive it very, very quickly. So, I mean, on one that all our listeners can relate to is COVID. Everyone's questioning what's going to happen. Are we all going to die? What's happening? And then it becomes clear, okay, we were not all going to die. People are going to go back outside. They're going to go back and do all of these things. And as soon as we saw, the Fed kind of come in and provide a backstop, and then coupled with, hey, this is under control, mortality rates much lower than we thought, vaccines and all this other stuff, you saw the recovery happen very swiftly within weeks. That doesn't mean that's what happens all the time. But even if it takes a long time, even if it takes 6 months, a year, it's still a gift to the investor. It's the few opportunities. What you want to be is a long-term investor and embrace the few opportunities you get to double down when the market's really struggling.
Yeah, so the odds are in your favor to embrace panic, whether you're a trader or an investor. If you just look at the historical odds a year later from these big VIX spikes, almost all the time the market's higher and it tends to outperform going forward. So if there's going to be a period of panic next year, take a step away, think about it, look at the history, and embrace it, because it's actually good news, because you're buying stocks on sale. If you have 10, 20 years, it's a good thing for investors to get that type of discount. Number 4, tune out the noise. And we had some noise around the presidential election this year, Peter. Of course, last year we had some people saying election years are bad for stocks. And then in this year, many times you heard headlines like this: why you should sell off stocks before the presidential election. And then after the election, there's headlines too: you should sell stocks now. So just please put this to bed in terms of how should investors approach this. It's going to be another 4 years, but it's kind of amazing that this has happened now a few times, and it's kind of the same lesson we're seeing again and again.
Yeah, I mean, I will say that at least among the creative planning client base, I did not see the same panic around who's the president this time. I remember when President Obama won, there were a lot of people that really truly thought they needed to exit the market, and some did. When President Trump won, there were also the same group of people. I see it every election, right? This time I'm seeing it. There's a couple people that went to cash, or they're moving to Europe or whatever. But it's a much smaller percentage. And I just almost feel like the polarization between Trump and Biden and Obama, this how strong people feel about all of them. I think they've just come to realize, you know what, the stock market went up a lot under all three of them. Maybe it doesn't make sense to make investment decisions based on who's the president. I think as we become more polarized, I think more people have come to that realization, thankfully.
So that's encouraging. Good. So
Yeah.
maybe the work we're doing is actually paying off here. People are listening. And if they were listening at the beginning of the year, we talked about just the data for election years. The market tends to be up during election years around 10%, which is a little bit better than non-election years. And it tends to be up a higher percentage of the time. So there's no rational reason to avoid this year. And if we look at what's actually transpired, well, we know it's actually been one of the best years we've seen so far. Total return of above 28% as we're speaking here, and all-time highs, Peter, 53 so far. Now, and that now is good for fourth place, tied for fourth place. Only 3 years. How about this stat? Only 3 years going back to 1929 have more all-time highs than 2024. 1964, 1995, and 2017. In good company, those years, very strong years for the market. And you and I did a show, I think, right around the first all time high. And we talked about what that was predictive of. And what it's predictive of is,
Was more all-time highs. That's
there
what
you
it
go.
was. Yeah, right.
100%. So it's
Yeah.
been a good run. 53. We'll see where December tends to be the best month historically for the market. So we'll see if we tack on a few more. But certainly an outlier, certainly not a year you wanted to avoid because of the presidential election or anything else. Uncertainty is your friend as an investor because it's the reason why you have that longer, above average long term return. Okay, number 5 here, diversification. Simple, not easy. This is my favorite chart that I like to put out. You can see all different asset classes, and every year there's a different top winner, right? 2011, long term bonds, 2012, emerging markets, 2013, small caps, 2014, real estate, 2015, NASDAQ 100. Then you have small caps. So it goes back and forth, Peter, back and forth. And the concept is simple. If you take a mix of all of these asset classes, you're never going to have the very best, but you're going to avoid the very worst. And that balanced portfolio overall will be easier for you to stick with in the long run. And you won't have to predict then which is going to be the best year in and out, which is a very difficult thing to do.
Yeah, I mean, the problem with being diversified is there's always something underperforming, right? You always wish you were all in on whatever's doing the best, and whatever's doing the best can do it a lot longer than anyone thinks, and whatever's doing the worst, you think it's going to recover can stay there longer than you think. But boy, when they can turn very very quickly. We saw that with small cap stocks this year. We saw it with emerging markets recently. You match the asset classes to what you're trying to do over the long run, and let them ride.
So why is it not easy? As you said, because you tend to see these long runs where you have domination in one particular area, and over the last decade plus, now it's been large cap U.S. growth stocks. So I'm going to show you 3 charts, and you tell me what the message for investors is in terms of staying diversified. U.S. to the world, we're now above 3 standard deviations above the mean in terms of the ratio between the two. U.S. outperformance going on 16 years running. Growth to value hit its highest level since March 2000. It's come off a little bit with value catching up over the last few months, but you can see here, been a tremendous run for growth stocks. And lastly, large caps to small caps a few months ago hit its highest level since October 1999. We've since seen an enormous run higher, and small caps hitting all-time high, so catching up to the S&P 500. But this is why, really, right, it's not easy, because how can how can an investor look at these long trends and say, well, I still need to have some small caps, I still need to have some value stocks, I still need to have some international stocks in case the future is not like the recent past.
Yeah, it's hard to look at, go back to 2000 to 2010 and go, well, large cap did zero and everything else did great. All we can think about is the last 10 years, right? And the last 10 years, large cap's beaten everything else. And so the question people ask is, why do I own anything else? Why don't I just put everything in large
Yep,
cap? And of course, when you look at charts and you look at multi-decade, it's easy to go. Rationally, things go up and down. I can't predict them. A good mix is the better way to get there with less volatility. But man, a couple of years or a decade is a long, long time when you're in the middle of it, right? It's not a chart. It's like one day at a time, thousands of days in a row, and you don't know when it's going to turn or when it's going to end. Just human behavior doesn't play well into that.
that's right. But we do know that there's no bell that's rung. So if, let's say, this is the turnaround where small caps are going to start outperforming and value stocks are going to outperform, and perhaps next year international stocks, We will only know it after the facts, which means you have to be diversified today in order to benefit from that. Okay, number six, there is no impossible in markets. We got to talk about Nvidia's rise over the last decade. 10 years ago, Peter, this is a $10 billion company today, among the three largest companies in the world with Apple and Microsoft. You're talking about a 300x gain over the last 10 years. I'm just going to throw this chart out here once again. Probably in contention for the chart of the year, I think. This is Nvidia versus everyone else in the S&P 500 in terms of returns over the last 10 years, 27,000% gain, and done 50% annualized in terms of its earnings growth. We have simply never seen anything like it. And if anyone who said 10 years ago NVIDIA was going to be in the position they were going to be in today, they would have been laughed out of the room. But here we are today. There is no impossible in markets, is what I like to say.
Yeah, I mean, what I love about owning the basket of the S&P 500 is you always catch this high flyer, right? I mean, the S&P this year, everyone's talking about how great it's doing compared to everything else. Really, a group of stocks is responsible for a lot of that return, and Nvidia leads the pack. And so we don't know what the next Nvidia is going to be. Just like you look back, there are famous names like Google and Apple, but there's also names people don't expect, like Monster Energy and Southwest Airlines, that led the markets for very long periods of time and lifted up the index. You don't have to look for the needle in the haystack. You just buy the haystack, you get it. This is how you get the outperformance. Yet there were stocks, we're not talking about them in the S&P 500, that went to zero. The thing is, the worst a stock can do is go down 100%. But a stock can go up thousands and thousands of percent. And that's why when you own a basket of diversified holdings, you catch that high flyer that lifts up the overall return, and you tend to outperform the stock pickers.
Yep. And that's the lesson, I think, looking at NVIDIA, because if you said, well, the analysts and the portfolio managers, they just own NVIDIA, it would be very easy to outperform. How many of them did? Very few, right? The
Right.
last decade, we're talking about a few percent outperforming their benchmark. And you don't know whether that's skill or luck, but very few people had a weighting in NVIDIA out higher than what its market weighting actually was. And if we look at in terms of impossibilities, I know you tweeted this out recently about Amazon's risky bet in terms of AWS and what's transpired. So exponential growth, I think the point here is very, very difficult to predict going in. This is now $100 billion business, AWS, which is bigger than I think like 470 companies in the S&P 500 in terms of that part of its business by itself. And Business Week is saying Wall Street wishes he would just keep to the core business at the time, which was just obviously the retail component.
Yeah, I mean, like it is very, very hard to believe, but there were no trillion-dollar companies just a few years ago. Now we've got a handful of them, and what we thought might be impossible, a trillion-dollar company. Some of these companies are bigger than most nations' uh, entire stock market or GDP. I mean, that's how big these have become. And it seems that a trillion is almost a guaranteed path to multi-trillion. And so now we're starting to see the emergence of the multi-trillion-dollar companies, companies truly bigger than most of the economies on planet Earth, and things that seemed impossible. Can these companies really continue to grow at this rate? The answer now we know is yes.
Awesome. Okay. Lesson number seven. This is the most important lesson. Year in and year out, time is more valuable than money. You posted this on X. Every day is a blessing. Time is the only currency you spend without knowing your balance. Use it wisely.
Yeah, I will tell you that, one of the things from sitting in my chair that I learned, I'm so thankful that I learned it at a very young age, is to enjoy the present. We all reminisce about the past, and we're thinking about the future, and we're very rarely realizing that we'll soon we'll be reminiscing about today. We should be getting everything out of today and now and this week, month, and year that we possibly can. A lot of people, you see the number one thing people worry about is wealth, unless they have a health issue. Then the number one thing they worry about, rightfully so, is their health. I mean, nothing obviously is more important than that. We never know when time is up. I remember I was in my 20s, and a client that maybe had gotten about $1 million in his account, and he was ready to retire. And he retired, and on his very first day, was digging a garden in his backyard and struck a line and died. And it was just stunning, all these things that he and his wife had planned to do in the future, and they were very sacrificial, like, skipped a lot of things to get to that point. And I've started to see a shift. People are kind of waking up to this, that, like, hey, you can't put everything off to tomorrow. You can't put everything off to retirement. You have to enjoy things right now, because we don't know. None of us knows. Every day is a blessing. We don't really know what we have left. And if you're ever debating about what's more important to you, your health or your wealth, if I could give you $10 million, but you're going to be dead in a week, you're not going to take the $10 million, right? Because obviously the time is more valuable. And I think the first step in really enjoying your time, making the most of it, is to just raise the awareness of just how limited it really is.
Yeah, you have to acknowledge it. And what all we're doing all this for, what I always say is, if for freedom. Naval had this great quote: money doesn't buy happiness, it buys freedom. So it's what you choose to do with that freedom. And you got to be purposeful. You got to actually make a plan, just like an investment plan, have a plan. And you talk about this 80 summers concept, not putting things off. And it's really at the beginning of the year, we're approaching time where people are making resolutions, and the number one resolution is always usually either get healthier or spend more time with family and friends. And those are great things, but actually make that plan day one. You don't even have to wait till next year. Make it now. Schedule that trip. Do the things that really matter to you.
Yeah, and it doesn't have to be like going to Switzerland, right? It can just be, driving to the mountains or driving to the beach or going to dinner outside of your bubble or whatever. But all those things that you're putting off,
Yeah.
stack them up. I saw something many, many years ago, and it was an elaboration on this theme of the 80 summers, but it basically said, like, well, how many more times am I going to have ice cream on this beach? How many more times am I going to go to Disney World? Really putting in perspective when you're at something, like, when we tend to be doing it, we tend to think, well, I'm going to do this 20 more times because it's the routine of our life. But you really start to think about the people around you that you're doing it with, and the
Yeah.
probability that all those people will be together. It really starts to bring home the value of the moment, the value of
Just
time.
meaningful time. And Thanksgiving, great time to reflect on that. It's just good being around simple things like my family. We got out the board games and just sat there and had fun and laughed. And you just got to sit there and appreciate those moments. You don't know how many more you're going to get. All right. We won't get into this. I want to get to signal or noise. Signal or noise, Peter, the national debt here. This is something that's come up now, fifth time, because we do it every $1 trillion milestone. So
We're
we
gonna be doing it
started
every
out.
week. We're gonna be doing it every week pretty soon.
Yeah. Right. Well, hopefully not. June 2023. Then we did it again in September, December of last year, July, and then now again in November. 36 trillion for the first time. I'm going to run through some numbers here. How do we get there? Why is the debt going up? Well, very simple. We're spending more than we're taking in, $2 trillion more. We are over the last 10 years. So then the question becomes, well, do we need more revenue or do we need less spending? The data here is we're spending about 90%, over 90% more in the last 10 years, and our revenue coming in is increased over 60%. So it's just the widening gap in terms of spending. Even though we're taking in so much more in the last 10 years, it's not enough to keep up with that spending increase. And the interest on the debt, Peter, this is a startling figure. This is the figure of the year, over 1.1 trillion now, and it exceeds the spending on national defense, which is kind of unbelievable. So just to service that debt, we're spending more than the national defense budget. Now, is there hope? This post on X gave me hope that maybe we're going to see a bipartisan agreement here, that there's fraud, there's waste, something could be done. This is a post from Bernie Sanders saying Elon is right, that the Pentagon $886 budget just failed its seventh audit in a row. It's lost track of billions. And he's saying that has to change essentially. Does this give you hope? Do you think something will be done about tackling this deficit issue so that our kids and our grandkids don't, and they're already inheriting this problem, but we don't make it worse for them in the years to come?
It is going to be fascinating. I mean, this is the Pentagon's one of the biggest line items, and you're going to have well, at least you're going to have the Democrats support the cutting there, and then we'll see if the Republicans support cutting on other issues. There needs to be cutting across the board. It doesn't matter if you're a Democrat, Republican, liberal, conservative. You like Bernie Sanders, you like Elon Musk, whatever. There has to be a way to contain the debt, and like monetary policy is confusing, and you know, I don't blame the average American for not paying attention to it. Who cares? We keep hearing about the debt going up our entire lives, and
Yep.
there's been no consequence. But there really is a consequence. These are the kinds of things that like end modern day civilizations, destroy currencies, create crashes. It does have to be contained. There is a glimmer of hope. There might be some actual movement here that is of substance. I'm we'll wait. We'll see. I think we're going to know in the first 100 days
Yep.
what everyone can rally around.
Yeah, so I think there's no question they're going to find things. They're already reporting the findings, and there hasn't been much pushback in terms of God, we're spending money there. That seems crazy. Like there seems to be agreement, but the actual bills have to be passed, so everyone's got to be on board. And as it pertains to the stock market, Peter, you and I've covered this, but let's cover it one more time. There's a difference between the way corporations run their businesses and the U.S. government runs their business, and the big difference is, of course, corporations run their business at a surplus to make profits. If you look at the S&P 500, the last 30 years up over 2,000%. And during that time, the national debt has increased 7x. So if you were worried about the increase, and I'm not saying not to worry about it, but if you said, I'm not going to invest in the stock market because of the national debt, that was a bad bet to make. And the reason for that, Peter, is again, because earnings are going up and to the right. Companies are becoming more efficient, more profitable. We've all benefited from the growth in technology over the last 30 years, and we see that in terms of corporate earnings. And what I like to say to the doomsdayers is let's do the worst case scenario here and let's play this out, right? The debt keeps exploding higher, the US dollar goes down, we have hyperinflation. Well, what's been the examples historically in terms of the stock market in terms of other countries that have had this high periods of inflation? What's better, putting money under your mattress in those scenarios, or owning the stock market? Owning the stock market, it's actually been the stock market, Peter. We could see the purchasing power of the stock market's been cut in half over the last 30 years, but the S&P 500 on an inflation adjusted basis is up 972%.
Yeah, if you have to be an owner, owning assets is inflationary. I mean, so owning the assets is inflates, with inflation, and so it's a great way to protect. And owning the currency, that's the part that gets crushed. Just having your
Yeah.
money in cash is not going to do well.
Yeah, to be clear, we don't want that scenario, but in that scenario, stocks tend to do better than most other asset classes. All right, Peter covered a lot of ground there. If you're watching this on YouTube, everyone, hit that subscribe button for more content just like it. We'll see you next time on Signal or Noise.